Good afternoon from London to everyone, whatever their time of day, to everyone who's joined us in such large numbers from all over the world, Europe, MENA, Asia Pacific, Africa, the Americas. I'm Stuart MacDonald, and I'm delighted to moderate this timely and authoritative webinar. It is the latest in the distributed ledger technology, or DLT, and crypto assets investment experts, Era Capital's thought leadership series of educational webinars. Now, today's webinar is a departure from our previous format. Instead of having two speakers, each giving a structured presentation around a specific topic, last time our theme was demystifying non-fungible tokens, NFTs, for professional investors, and then answering questions. This time will be more open-ended. We'll be covering a diverse range of issues and developments within and around the DLT and crypto asset space. To help us, we have some real experts, each representing a different facet of the space, the industry. We have Ankush Jain, Chief Investment Officer of multi-manager DLT and crypto asset specialist Era Capital. We have Paul Gordon, founder and publisher of CoinScrum, one of the most authoritative sources of information and one of the longest established communities within the crypto space. We have Alessandro Balletta, co-portfolio manager of a very successful single manager crypto fund at specialist alternative investment fund managers Fasanara Capital, and not least Konstantin Anisimov, executive director of CEX.io, the crypto exchange trusted by over 4 million general users, and CEX.io Prime, which is used by over 50 institutional clients to access over 100 digital asset markets. Now, we all know that the broad DLT growth story is at the heart of the economy of the future, and one which is full of both immediate and longer term investment opportunities, whether around the proliferating applications of blockchain and analogous technologies, or decentralized finance or DeFi, NFTs, crypto assets, including tokenization and cryptocurrencies. Era's thesis, which I believe to be shared by all of our panelists, is that together, especially if this is done in a carefully risk-controlled manner, these developments present potential return patterns with strong upside potential and returns that are notably uncorrelated with other investments, whether traditional equities or bonds or alternatives like hedge funds. Now, these thought leadership webinars are designed for investment professionals to learn more about this fast-growing, often complex and fast maturing space, still often misunderstood. But we all know that there is serious interest from serious players, by now too numerous to enumerate. I think Era Capital is the first player, to my knowledge, with a truly institutional quality, multi-manager, multi-strategy approach to it. But I think the same compliment might be paid to each of our other panelists. Now, if you want to learn more from any of our panelists, Era's contact details will be at the end of this webinar. They'll be available to you, and we can refer you to any of our experts. More immediately, if you have any questions for the speakers, please put them into the chat section. The earlier in the presentations, the better, or the earlier in the panels, the better, and we'll try to address them if we have time. But now, without further ado, here's the substance. So I'd like to start with a specific question, and we'll start with you, Ankush, and then take this on a round robin basis. NFTs, what are the implications of NFTs, the use cases, and where applicable, what are the investment opportunities?
Yep. So NFTs are a very interesting area. They've grown a lot over the last few years, from practically nothing to a full-fledged industry where large brands and established companies are now getting involved. I think in the most recent weeks, the largest piece of news has come from Facebook. They want to rebrand to Meta. They talk about the idea of metaverse, where NFTs will be used as digital items and crypto assets will be used as forms of transaction. Now, in the purest sense of the word, NFTs should really be used in a decentralized setting. So when people talk about Facebook and they talk about corporations getting involved, it kind of goes against the idea of communities and decentralized autonomous organizations getting involved in the space. But it's just, it's validity. It's just showing that there are large companies now getting involved and they want to get involved with this part of the market. In terms of how to gain exposure, there are quite a few different ways to do it. There are now NFT and metaverse funds that hold NFTs. They're also almost like private equity vehicles, quite liquid, but getting you that long-term exposure to that part of the space. There's also metaverse equity funds. So get you exposure to things like Facebook or Microsoft, or even semiconductor companies like NVIDIA. And then also long-term crypto hedge funds. So they, could be indirect exposure to NFTs through NFT marketplaces, could be metaverse tokens, gaming tokens like Axie Infinity, digital land, Decentraland, things like Engine, or even other parts of the market. Because the interesting thing about crypto assets in general is that it's all kind of interlinked. So you could get exposure to NFTs through layer 1 protocols. It's like indirect exposure to the underlying base protocols. You could get exposure through DeFi. Some NFTs you can fractionalize or you can stake, you can earn yield on them. So it's all interlinked, and it's very interesting because it's perhaps the most retail-friendly use case at the moment. You have brands like Dolce & Gabbana, Nike with digital clothing. You have Bollywood actors releasing NFTs with digital posters. You have companies mapping out New York City and talking about the idea of a metaverse where we can use tokens and you can transact in the digital world. So unlike maybe 5-10 years ago when the idea was a bit more abstract, it is coming into reality, and the numbers are quite astounding in terms of volume and number of users actually getting involved. So a really exciting space, a number of different ways to get involved, and I think the only way is up. And when we see the role of technology and the way it's accelerated since COVID, it's only going to accelerate over time.
Okay, thanks for that, Ankush. Let's go to you, Paul. Would you like to pick up on that? Take it where you will.
Yeah, no, I appreciate the introduction from Ankush. I think that sort of covers the ground nicely, or sets the scene nicely. And I think there's something Ankush alluded to there is, although we've seen this sort of Cambrian explosion, or seems like a Cambrian explosion especially over the last year, as an idea, as a concept. And I guess before they were given the moniker NFTs or non-fungible tokens, the concept's been around for some time, even before Ethereum. I think as a specific vertical within, if we term the whole blockchain industry, I think this is super interesting, and I just think it has a huge amount of legs. But at the same time, there's a certain amount of caution and buyer beware at this stage, because I think many of the known issues that were maybe discussed a few years ago have been sort of put to one side potentially during this particular hype cycle. And look, that's never a bad thing in crypto and other markets. We see hype cycles, and we see Gartner type cycles where you get overextension of exuberance, things settle down, but then real stuff gets built. And I think we'll see the same here. But there's many questions over the long-term questions around interoperability, and we've got NFTs and what are supposed to be sort of provably unique tokens being issued across multiple blockchains. No one knows for sure those blockchains are going to survive. What does that mean in the future? What does that mean if there's a blockchain fork that we've seen many times across certain networks? So there's many questions, and so my concern is that there's a lot of people entering the market maybe not as informed or knowledgeable as they should be. And I just urge a little bit of caution to be exercised, to do some research into what it is you're actually buying. And just on to one critical point, and I know it's something that's being resolved, but I was quite shocked to find only earlier this year that the main smart contract standard that was kind of being utilized, ERC 751 on Ethereum, effectively really just works like a digital locker rather than acting as provenance or actual guaranteed provenance that a digital item is unique. This is being addressed. Things can be structured differently so that you can verify something is actually unique. But again, there's just one kind of clear example where the main smart contract, the main standard, wasn't actually doing what it purported to, I guess, in many ways. So just a summary from my point of view, very long-term bullish on this, but there's still work to be done. I think a little bit of re-architecting across the ecosystem.
Got you. Alessandro, would you like to continue that?
Yeah, absolutely. And perhaps just to continue from, the discussion on NFTs is really not necessarily about investing. So perhaps NFT represents one of the main channels for mainstream adoption going forward, which doesn't necessarily mean that any given NFT by itself is an investment opportunities. I do see a lot of upside and a lot of potential for NFT being used as tickets in events, concerts. Gaming obviously is one of the biggest industries nowadays and growing very strong. People are spending billions of dollars for digital assets that are not really their properties, but are instead hosted on some centralized servers. So the adoption of NFTs from centralized companies, so contrary perhaps to what Ankush was saying in terms of the nature of decentralized, the decentralized nature of NFT. Instead, they perhaps provide a nice bridge between the two worlds, because we are going to see more and more, because let's be honest, interacting with the blockchain is still quite complicated, and unless you are really familiar with the technology, it can be a bit daunting. And so I think really the way forward is for number of corporations, centralized corporations, to offer a layer on top that will allow users in general to interact with different, and this is perhaps what Mark Zuckerberg was describing in his keynote presentation, because it's not necessarily because a platform is centralized that this doesn't allow interoperability. And so I see a lot of potential adoption coming from there. Obviously, the user base of these platforms is already huge, and so it can really provide a point of access to the whole industry for billions of people potentially.
Excellent. Thanks, Alessandro. Already it's clear that NFTs have a lot more to them than a set of cute profile pictures. Konstantin, do you want to pick up on this?
Yes, thank you, Stuart. I'd like to actually approach this from a very different angle. One of the things we're studying quite in depth at CXAO is central bank digital currencies and how they will influence the adoption of digital assets at a greater scale, I would say. And one thing that I am personally very much interested in is how a use case for NFTs in government sectors, for example, birth certificates, house deeds, ownership of your motor vehicle or anything, boats, university degree certificates, all of these things, especially when you don't just operate within the remits of one country, but even if you do, buying a house in the UK, everybody knows how much money you need to pay the solicitors, how much time it takes. There's all these extra checks that they have to do, and that is important. But if all of that was on some sort of government-controlled blockchain, be it distributed or not distributed, that's a different discussion. But the technology which the NFT and the smart contracts provide can allow for much greater efficiency in the government operation in general. And the main thing is we all as citizens can live a better quality life and worry less about these mundane tasks that nobody wants to essentially get involved with and pay a lot of money for. So that's where I would like to see it go. I hope it does.
Okay. Ankush or any of the rest of you, would you like to add to that, Ankush?
Yeah, sure. I mean, I echo the sentiments that we are very early, and at the moment people are paying a lot of money for profile pictures. With the idea that in the future might have a huge amount of potential, might be worth a lot of money. I think at the moment people are spending 50K on monkey profile pictures and 400,000 for CryptoPunks. But yeah, in the long term, there is definitely use across multiple industries. It might not be entirely evident what that use may be right now. More the focus is on crypto as opposed to what those real life applications may be. I mean, in some ways, it's kind of like ICOs in 2017. It was the year of ICOs. A lot of projects raising capital and not necessarily in the right way. There was a bubble and then it burst. And now, everyone's talking about tokenization, and in the future, how in the asset management industry, things will be tokenized, how other assets will be tokenized, how it's going to really help in terms of liquidity and transparency. So there are quite a few parallels to a few years ago. You do have cycles of bubbles and bursts with any new technology, and I think NFTs are the most recent trend, and coincidentally the most retail friendly one. So in the short term, I think we're definitely in a bit of a bubble. People paying a lot of money for profile pictures and things that may not necessarily make the most sense in the real world. But as time goes on, we'll see a lot more applications that make a lot more sense, and might be used by governments, might be used by centralized entities. In a practical sense, nothing can be 100% decentralized, and we'll eventually reach that equilibrium where things make a lot more sense.
Okay,
Yeah.
thanks for that. Paul.
Yeah, no, I just wanted to, I mean, firstly, definitely agree with Konstantin, and I think that idea around using this technology in its various forms around identity and what that's going to mean for broader efficiency in the markets in general, not just around NFTs, around DeFi and outside of the blockchain industry in general. I think that's going to be a big topic for the coming years ahead for this industry in particular. But equally, I think it's important for people, if they're looking at this afresh, to if they're looking for investment or at investment opportunities, you've obviously got two aspects here. You've got direct investments into these collectibles, these artworks themselves, and that's down to pure speculation. I'm sure if anyone's had an eye on the art market in general, the traditional art markets over the years have probably raised a few eyebrows around valuations and, how do you value these things? So that's for the market to decide. So maybe that's clearly a speculative aspect to that component. But then you have got the platforms themselves that are going to be leading the drive and the innovation and the evolution of this particular market as well. So no doubt there's going to be equity investment opportunities, token investment opportunities into those platforms as well. Maybe this isn't investment advice, but obviously maybe that's a safer way of gaining exposure to this market, focusing on the people building the picks and shovels, so to speak.
Look, in case or any non-professional investors who have by accident come into this or get exposed to this so far excellent webinar, we're not giving investment advice here. If you're not a professional, regulated, accredited, or qualified investor, go and seek professional advice, regulated professional advice. Alessandro or Konstantin, do you want to pick up further on the NFTs?
Yeah, so I just wanted to comment. Indeed, I agree with Paul on the investment opportunities and why it is actually very complicated to invest in NFTs themselves, and why maybe preferable to invest in tokens representing interest in platforms. And indeed, the lack of liquidities of NFTs is a big problem. No one really wants to hold a liquid portfolio with huge bid-ask spreads. Difficulties in valuation is another consideration, clearly. But also diversification. I mean, many of the assets we have been mentioning are trading for a considerable amount of money. So even with institutional portfolio of few $1 million, you might not be able to achieve the level of diversification you might want going forward, because clearly you don't want to concentrate too much your bets. At the same time, we did mention this is a speculative market, but at the same time we are seeing really something unique being built around these assets, and perhaps collectibles and profile pictures might sound a bit stupid, but then we had the news from a couple of days ago. Universal Music bought, or in collaboration with an NFT studio, is basically putting together a band, a music band where the characters are actually the apes that are among the most famous NFTs. And so we are witnessing brand creation, and it's quite interesting to see how this is happening in an open market, rather than being trademarked assets, because you can buy an ape yourself and effectively create a derivative of the same project, and effectively strengthening the main product, be it the band or be it the whole community. So as I said, quite interesting, but at the same time, quite a concentrated bet. So indeed, tokens may be a preferable way to go.
Thanks, Alessandro. And it's so interesting that with every new dawn, it's a new day, which simply repeats much of what's gone before. The idea of having apes as the characters representing musicians in the band is not exactly new to any of you old enough to remember gorillas. Konstantin, would you like to add anything to this? Otherwise, I'll go to Paul.
Just a quick one. I think what Alessandro mentioned is very important, that if you want good, diverse investments, then it would probably make more sense to stay away from direct investments in NFTs. However, at the same time, what we're seeing is, I'm just reading an article, I was reading an article earlier today about LVMH, creating their own, essentially what looks like their own blockchain accelerator. They don't disclose why they're doing it exactly, but my guess is there will be NFTs in the mix somewhere there, as well as potentially some provenance chain. And coming back to the value point that was mentioned earlier as well, that a lot of these valuations don't really make sense right now. That is not to say that they won't in the future. And I think there's a paradigm shift happening right now where we're not used as humans, we're not used to pay a lot of money for a digital file yet. But as the big brands as the big brands become more familiar with that concept and the customers become more familiar with that concept, I think we as humanity will realize that the value of those digital assets is the same as the physical assets or on par with the physical assets. And that would be one of the big shifts that NFTs are bringing to the humanity right now.
That is very interesting indeed. Paul, would you like to pick up on that?
Yeah, sorry, I was actually raising my hand just around your point about the gorillas, because I was going to make the same point. But no, just to follow in with that as well, and I think just to close the loop on, I think was mentioned at the top of the conversation around Facebook and their, Mr. Zuckerberg's long-term vision around the growth of the metaverse, as it's being termed. Lots of activity around that, and it just strikes me that we're going to have this ongoing debate about, which Ankush mentioned at the beginning as well, about centralized products, fully centralized products versus decentralized platforms, where all of this activity takes place in the future. And it does seem that the idea of a metaverse and 3D worlds where people can conduct commerce using natively digital items, because that's really where they work. We'll probably come onto it later, but there's been ongoing discussions and even talking about central bank digital currencies where you're using the technology, but you're not not using it in its purest sense, where you're addressing settlement finality and that risk and counterparty risk that you may still have against a central bank issuing fiat currency or companies issuing stock on the blockchain. But these items are, and back to Konstantin's final point as well, we're going into a new world where these things are natively digital, and that is a big difference. That's a marked difference, and this technology will prove itself over time.
That's great. Listen, I think I'm going to move the conversation on. We can come back to NFTs per se the next time we all gather together for one of these webinars, unless anyone's got anything urgent to add. Ankush, do you want to add something? And then we'll go over to, I think we'll move into decentralized finance, DeFi. Ankush?
Okay, what introduction to DeFi?
No, what I wanted to say was, what I wanted to ask you was, you looked like you had something to say about NFTs. If not, we're going to go to Alessandro, start with him on DeFi. Then go to you, then to Konstantin, then Paul, in that order. Alessandro, I mean, decentralized finance is as much in people's minds as NFTs. What do you make of it?
Yeah, I mean, we can say so many things about DeFi. Perhaps I'll start with something that, again, I think maybe one of the main channels for adoption. And again, I'll take it from the institutional point of view. And now I'm referring to something that news that was out a month ago, which I find very, very interesting. This was Société Générale, one of the largest banks in France, that applied to MakerDAO loan, 20 million loan collateralized in tokenized bonds. Now I find this really very important, very interesting, and the way forward for more and more adoption. I mean, I can picture JP Morgan applying for loans and using, perhaps releasing collateralized mortgages, and then why not? The governance holders of a protocol rather than another might allow this to be used as collateral, and why not? JP Morgan might try to engage users by dropping JP Morgan coin on whoever is using this collateral. I mean, obviously the size of markets in fixed income and in traditional finance is huge, and if we see some percentage of these moving into DeFi as collateral, I think it can bring a lot of more liquidity and adoption to the market. And so yeah, perhaps I'll start with this, see what the others think about it.
Cool. Konstantin, do you want to pick up on this?
Yes, happy to. what I'm seeing as well is exactly as Alessandro pointed out, that even though many institutional players don't really understand DeFi, they may not believe in it, but the returns that you get from it, coupled with the limited risk. So if you compare investments into liquidity pool versus, say, direct loan-only investments into Bitcoin and Ethereum, you can achieve comparable returns with a much less risk, especially if you know what you're doing and you've done audits of the smart contracts, etc., or you use a trusted counterparty to do that for you. And I believe this offers a very interesting proposition for institutional investors. In addition to that, what is happening right now is the support for multi-chain. And another thing that happened this week, I believe, is the Taproot update for Bitcoin blockchain. So all of these things allow for potentially allow for institutional grade custody, where your assets are stored in cold store, and the chances of your assets being stolen or hacked are very, very minute. And then at the same time, via staking, for example, you can generate passive returns, or via investing into a liquidity pool with 2 or more stable coins, which in essence mitigates, pretty much negates the risk of impermanent loss. That, coupled with good diligence on the projects that you invest in, you can easily generate 10%, maybe 15% annualized return for holding your assets in what is essentially US dollars. And one of the things we're seeing quite a lot of is the institutional players in the European Union who have to hold their assets in euros, who are being penalized with negative interest rate right now. Everybody's looking for a way out of that. Nobody wants to pay a bank an invoice for the interest for holding, say, $100 million, 100 million euros. So one of the use cases we're seeing right now within the institutional space is potentially taking those euros, converting them with a hedge for the FX, converting them to USD-pegged stable coins, because unfortunately in euros there isn't a good collection of stable coins that are, that offer a big enough market, and then putting those assets, the stable coins, into liquidity pools and generating returns that are completely unheard of compared to storing your assets in the bank accounts.
Cool. Ankush, do you want to add to that?
Yeah, sure. I think the institutional adoption and involvement is very important, but realistically, I'm not sure how long it's going to take, because DeFi is moving very quickly. It seems like there's a new development every day or every week. And although there is some involvement and some evidence of institutions getting involved and chasing those returns, I do feel that they're always going to be one step behind. I think a good example of that is like last year in the middle of the compound, they issued tokens, and they were trying to promote adding more liquidity to their project by issuing these tokens. And the returns on investment were very good, far and beyond what you get in the traditional world. But it led to a bit of a trend in that other projects started offering the same thing. Users searching for yield would go with one project, they pull their capital out, move to another project, and led to a bit of instability. And now we've got a new innovation in the form of the actual project earning liquidity. So there's one project called Olympus DAO. I think the current yield is 8,000%. And it uses a form of game theory where you can stake, bond, or sell. And it leads to a lot more stability. But I mean, for institutions, they'd look at that and they wouldn't touch it, because it's completely new. It's pure DeFi. It's not regulated. It doesn't. You can't unless there's like another bridge or a way in. You can't do KYC, AML to get into those kind of things. So I mean, yeah, the institutions are getting involved with, I'd say, the lower yielding and low risk parts of the market. We can get maybe 10%, 20%, but it's changing all the time, and there are much higher returning opportunities elsewhere that actually crypto funds are getting involved with, who are often the first movers. So like crypto DeFi market neutral funds, at the lower end, they'd aim for 20 to 30% per annum. At the higher end, if they want to take on some directional risk, they'd go into the hundreds of percent, maybe thousands. So I think it's good. It's needed that you get those institutions in, getting them involved in the market, but realistically, it's going to take some time before, again, we reach that equilibrium where we have the regulated side, the unregulated side, permissioned, permissionless, and the rate of innovation, being adopted and used by some of the larger players. I think we're still very early. It's grown a lot, but it will take time before the large players can get a bit more comfortable with those higher risk opportunities.
Cool. Paul, would you like to extend that? You're muted, Paul.
Sorry, apologies. Yes, I mean, I think it's definitely important to look back slightly as well, because it's only 4 or 5 years ago where the narrative from most financial institutions was, we'll take it from here, we'll form our enterprise blockchain alliances, and we'll just have our kind of nice walled gardens that we deal with and utilize the technology in that way. That's not really panned out as such, and definitely it seems that the sentiment now is, well, yeah, public networks are going to certainly have a role to play in their future, but they're obviously, as Ankush says, going to move very slowly, but that interest has clearly grown. And so it's whether old alliances and networks such as the R3 consortium and their Corda network, to the Ethereum Enterprise Alliance and their private use of the Ethereum technology, to newer platforms such as, or networks such as Avalanche, which have been designed from the ground up to accommodate both sides of the market, from the public network to more private use cases as well, that should seamlessly interoperate. So I think sentiment's changed, the interest is there, as Ankush says. I think this is all does again come back down to regulation and identity. And, financial institutions are going to be happy to utilize this technology if there's obviously opportunities, profit opportunities for one thing, but also around market efficiency. But we're already seeing early implementations from certain DeFi platforms for their KYC liquidity pools, for example. So it is coming in small steps. These firms just are going to have to get comfortable with the risk, and we know that takes time.
Well, it seems like, looked at from one angle, DeFi is just an ephemeral form of shadow banking that will soon enough, pass. It'll, as soon as the incumbent traditional financial institutions get their heads around it. On another, something that none of you have mentioned, it could be at the core of a tremendous process of democratization. There's a third option, that it becomes a feature of a dematerialized world in which economic activity is specialized, especially the mobilization and dispensation of capital sinks into a series of those metaverses that you guys have hinted at. I wonder, Konstantin, do you want to extend what's been talked about so far?
Yes, happy to. So I'm actually thinking of a couple of points I would like to expand on. First of all, we touched upon the truly decentralized solutions versus centralized. And the interesting thing is, one of the prominent, it's not a leading network in DeFi, but one of the prominent networks in DeFi is Binance Smart Chain, which you could argue is very centralized, actually. However, it does offer the convenience of lower fees, and it offers a more democratized access to those investment opportunities compared to Ethereum right now, where essentially if you invest anything probably below $50,000, you're unlikely to get any return out of that because of the fees. So what was designed as a very democratic, low barrier to entry, was, due to the demand that it's seen, has actually become very high barrier to entry. And yes, we may not have pension funds in DeFi, but there's a lot of whales in DeFi for sure. And what Ankush was saying with regards to moving the funds, etc., we obviously invest in DeFi ourselves, and we have people monitoring these things round the clock, so that we know if there's an outflow of capital, we pull our capital out as well. We don't want to be stuck in that pool when everybody's taking their capital out. And so there's all of that, the ideology behind decentralized. But then when you offer convenience, the majority of the users of the network forget about ideology and they prefer convenience. Unless there's obviously another solution which offers both. And I wanted to draw an analogy with Android and Apple, where one offers Android offers very much open source, open community, and Apple is the complete opposite to that, right? Everything is closed source. You have to confirm everything with Apple and seek approval. Both exist very well. And what I'm trying to say here is, I don't think there is a holy grail here, and there's a chance that there would be different, and maybe the term DeFi would have to evolve in a sense as well, because it could be a centralized, controlled ecosystem which allows for innovation and participation. Just one last point I wanted to make as well on about what we said with regards to institutions catching up with innovation. I think it's good that the large investors, traditional investors, are actually not on the forefront of innovation. It, to me, would sound a little bit dangerous. And it's also great that we have the instruments for innovation within DeFi. I find it truly amazing. The pace of development is astounding, isn't it? And I hope that the regulation, rather than changing DeFi for the existing regulatory perimeter, I hope the governments actually see the benefit of that innovation and adjust the way they regulate rather than the other way around. For example, why penalize the DeFi protocol if you could penalize the participants? If there was maybe a method where the community of the protocol would vet people or participants in and out, so you don't have the standard traditional KYC, but you have almost like if we went back many hundreds of years where you'd have a small village community and there was one bad actor, then the whole village would find them out and shame them essentially. And I think that becomes possible with technology like this.
Of course, let us hope that we don't end up with people being burnt at the stake. But Alessandro, then Ankush, then Paul, just to wrap that up. That was really good, Konstantin.
Yeah, so just couple of points perhaps on this last one about governance, and obviously we have to look for a solution, but I think it's quite dangerous territory, because indeed we said, we don't want to really cancel people out, in particular when governance is based on economic power, because at the end of the day, this is not really a democratic process, because it's not one vote per person. Here is one vote per tokens, and tokens are for sale. So votes are for sale, and we should pay attention how the voting power is used. And yeah, perhaps that's as far as it goes on that. I wanted then to comment on the user experience, which indeed is one of the struggles these days in DeFi, and the trade-off, as Konstantin mentioned, you have more centralized, more decentralized solution. And indeed, I do not see them as in opposition one to the other. I perhaps see them more in a hierarchical structure. I mentioned before Ether, and perhaps it should be considered more of a blockchain for businesses. I mean, indeed, you can't really pay hundreds of dollars for buying an NFT or deploying a position on AMM. So there may be a more layered solution where the end user will want to use a centralized provider, and there are already a few. This will be and should be cross-chain, so that the user seamlessly can deploy capital across different blockchains. And this might first propagate through L2s to still maintain cheap transactions, which then get batched and saved on the finality layer, which might be Ethereum, and at that point is fine, is actually desirable. The transactions are expensive, and so I think we are going a bit in that direction, which I think may be the good direction to go. Okay,
Ankush.
Yep, I think the point about a multi-chain future is correct, and that extends beyond DeFi. It's not just going to be within that, but specific to DeFi, I think regulation is extremely important. Again, the correct balance is important. I mean, Konstantin touched on rather than penalizing platform providers, looking at participants and them taking ownership. But then there's the trade-off between consumer protection and innovation. If you think about regulating platform providers, so far we've seen FCA looking at Binance or FTX and stopping products with 100 times leverage because that protects consumers. But if they do that, then they're stifling innovation. So there's the trade-off there. If you look at participants and ask them to take ownership, so you do some KYC, AML, then how do you protect them if you don't regulate the actual platforms? So I mean, it's a bit tricky to know where the balance is, which part should be regulated, with who should be held accountable, and especially when you have decentralized governance or decentralized autonomous organizations, which could potentially replace the role of traditional corporations, then it gets even more complicated because there are a lot of different trade-offs within that itself. So if you have whales, if you have very large participants, they can control the outcome, similar to how they control an outcome in a company. There might be mixed incentives, different incentives of people who control those organizations compared to the incentives of the actual project. It's a pretty complicated area, and I think the innovation has been really good, but again, it's realistically going to take time because it's so complicated. It's changing all the time. There's lots of different incentives in different directions. There's also the regulator, which needs to protect consumers and promote innovation at the same time. Institutions looking to get involved because they want yield. And realistically, it's going to, I think it's going to take a few years before we reach a point where, people are comfortable, or at least where you have a better balance between things. In the short term, there will be periods where there's bubbles, periods where unfortunately some consumers will get hurt, and it's part of the process. So it would take time. I guess that's the key point.
Well, Ankush, we don't all have to have exactly the same conclusion for the moment about where any of these developments are leading. They're all terribly important. And you mentioned the word regulation. Paul earlier hinted at a big issue that's out there around privacy and identity. And I'm wondering, Paul, if you'd like to pick up let's spend a few minutes before trying to look at what's happening in the markets, if we have time, looking at regulatory and other developments in the market structure, its components and function, and equally if there are any particular investment opportunities that are thrown up by that. But Paul, I wonder if you'd like to pick up on that, and then we'll take it forward.
Sure. Yeah. I mean, I touched on it earlier, and it is definitely for me personally, and I think for the market in general, over the next few years, is going to become an ever more present point of debate and discussion. We're seeing it already. Obviously, earlier in the year, we just saw China come in and say, right, that's it. We're kind of. I mean, they've made it difficult for any sort of crypto asset trading for many years now, but then they came in and finally outlawed Bitcoin mining specifically. So half the network was switched off overnight. People say how robust these networks are and safe from attack, and it just proves that half the network can be basically attacked and turned off overnight. I mean, it's been recovering, and you can argue that mining's become more decentralized, but it's just a point in case that, as I've always said, this industry will always become a victim of its own success, because the more the higher the market caps go, the more concerned regulators and governments get. And I think specifically with what's going on more in the macroeconomic level, over the next few years, you're potentially going to see the US dollar come under more attacks, and potentially a two-pronged attack. You've already seen the Chinese launch their digital yuan, so their central bank digital currency is live, being used. And the Chinese have big designs on bypassing the US dollar dominance. And then at the same time, if Bitcoin carries on rising, being seen as an alternative asset and a safe haven from a weaker dollar, potentially the US is going to feel it's under attack on that side as well. So it's going to be interesting to see how they react. And as we've seen in the last week, the new US infrastructure bill was signed off just this week. It's still too soon to say what the long-term implication is going to be, but it does put crypto under attack, and participants within these networks potentially in difficult positions, depending on how these basically that whole discussion plays out. So I just think, as on one side you're going to have institutions, you can have big investors keen to get involved. They're going to be asking regulators what needs to be done, or for regulations, so they can participate. But at the same time, you've got to look at what the pushback is going to be from governments, and I think that's a big area of concern going forward.
Terrific. Alessandro, then Konstantin, then Ankush.
Yeah, I mean, in particular regarding the pushback from governments, I think perhaps in the present environment, one of the biggest risks in terms of price action may be coming exactly from regulation. It was mentioned this part of the tax bill, these provisions about who's considered a broker, who's not considered a broker, and there were early talks about minors being involved and so on. So this obviously represents a risk, and it depends how it gets interpreted as soon as it becomes active. And a second one on the regulatory field is obviously the stablecoin. We've seen already there has been suggested that they should be regulated as banks effectively, which, to be honest, is not too strange to think, but obviously this represents a great risk, because can we imagine Tether being able to get those licenses? I don't know. And obviously the market nowadays is relying considerably on these centralized stable coins, because I mean, we've been talking about DeFi earlier, but basically everything, half of the DeFi is based on stable coins, and half of, well, the vast majority of stable coin is actually centralized. Tether is IOU on Tether balance sheet, or same for USDC. So there's a huge risk, potential opportunity for truly decentralized stable coins. But this is going to be, quite interesting to follow and quite difficult to predict how it's going to work out, in particular because for decentralized stable coins, we have some examples of things that work, but there has been lots of failures, in particular in the camp of the algorithmic ones. And so hopefully we'll have the time to innovate before regulation becomes too stringent.
Okay, Konstantin.
To add to Alessandro's point, I actually wanted to speak about stable coins and regulation, and well said there. I think I am a believer personally of algo stable coins, and I think it's one of those things where the innovation will have to come, because I see governments cracking down on stable coins, especially if you've studied the MiCA regulation, proposed MiCA regulation, and what the Bank of England had done, etc. It seems like the governments at this point in time, at least, are only really concerned with stable coins that can affect their own currency. So the Eurozone will mostly care about the stable coins in Euro. However, it remains to be seen how they would treat Tether, for example, which doesn't pose a direct threat to Euro. However, if coming back to the example I've made earlier, if suddenly we'll see billions of dollars of euros exchanged for Tether to be staked in liquidity pools, put into liquidity pools, then that becomes a risk for the whole Eurozone. And the Eurozone loses control of the monetary policy potentially. So I think whichever way it happens, there will be more regulation with stable coins. And however, we need them within especially the distributed finance, but also in general, outside of EU, US, etc. We need those stable coins. Well, for example, if we take government countries with high inflation rates, I'm aware of small retail users who would essentially convert their salary into some sort of stable coin, hold their salary in that stable coin, and then convert it back as the month goes along, because the inflation is way too high and they would lose a lot of money. And that is, again, democratizing access to these instruments, whereas before only high net worths had access to these instruments. Now anybody with a mobile phone can do it, which doesn't necessarily make the governments happy about it. And that raises the other concern, again, the losing control. So I think there will be a shift, and the only way you either become a bank as a stablecoin provider, in which case the model may not work. You may need a lot more capital, and then it may not be as liquid as it is right now with Tether, for example. Or you need an algo stablecoin where the governments cannot necessarily claim to have any control over it. There's nobody to regulate it. It's completely, there is no legal body to be unhappy with. I guess the only thing the regulators could do is control the inflows and outflows into that stablecoin potentially, but that remains to be seen. And I think one other thing I wanted to point out with regards to markets and pricing, I'm personally very interested in two things: the ability to execute smart contracts on Bitcoin blockchain with the latest update, and how that potentially might change the adoption of Bitcoin, especially if you take into account all of those people who hold large amounts, and they could potentially in the near future stake Bitcoin to generate a return. That could be quite interesting. And the second one is Ethereum 2.0, which we've been waiting for forever. But
He's frozen. Ankush, do you want to pick up on that?
Sure. I actually wanted to take things from a slightly different perspective and talk about
Sure, by all means.
crypto fund regulation.
Sure.
And I mean, over the last few years, there has been a lot of development. You can split it up into two areas. You can see like how funds are being regulated in general. So in terms of AUM, the operational setups and their structures. And then you can also think about like the crypto side of things. So tax treatment, how securities are classified, whether crypto assets are classified as securities, commodities, or other assets, and what the view of the regulator is on that. So on the structure side, things have been improving. Funds are getting larger. There's a lot more funds going over the required thresholds to get regulated. So above 150 million in the US, above 100 million in Cayman, and so on. So we're seeing a lot more funds starting the process of filing with regulators, and there isn't much pushback when they hit those thresholds. In terms of setup, things are improving. I mean, there's a lot of variation between funds, but the regulators are looking at these setups, and they're seeing that the setups tick a lot more boxes than they did in the past. And then on the crypto funds, like the crypto side of things, there has been some development. So, for example, in Switzerland, a lot of funds have been getting regulated, approved by the regulator, particularly on the passive side. So you have lots of ETPs and similar structures come to the market. In the US, you have Bitcoin futures ETF that was recently approved, not a spot ETF. So it's kind of like a half win there. And then in Asia, a lot more conservative. So I think in Hong Kong, there's only 2 or 3 funds which have been approved by the SFC, the regulator in Hong Kong, a lot more conservative. So, I mean, things are generally heading in the right direction in terms of setups. On the crypto side is a bit more unclear, but generally looking up. So we're seeing a lot more funds coming to the market, either getting regulated or already regulated because of their size and the way they're operating.
Cool. Who wants to pick up on that? Konstantin, do you want to pick up on that and go back into the regulatory space? And then I would like to bring this around in the very few minutes remaining to us. A question just arising from one of the audience. I mean, given what's happened in the crypto markets over the last couple of days, I haven't seen them today, but as of last night, the price of Bitcoin had plunged below $60,000 amid what looked like something of a market-wide crash. This came less than a week after BTC had peaked at a new all-time high at $69,000. And you have Ethereum, Binance Coin, Solana falling between 5 and 10% each as well. So it'd be good to know what's going on. If you can put your finger on any of that. We have literally about 4.5 minutes left, so you've got about a minute each. We'll start with Konstantin, then Paul, then Alessandro, then close with Ankush. You've got a minute each. Konstantin.
Thank you, Stuart. To respond to your question, I personally wouldn't have a clue as to what actually happens, and I want to be very frank and honest about this. I think a lot of the things that happen in crypto are sentimental, and not everything can be explained with defined logic. I mean, take SHIB, for example, or Dogecoin and things like that. people concentrate on the Bitcoin falling much more than the Bitcoin rising and crypto in general. And if we say, well, Ethereum dropped so much, but have a look at by how much it grew. And it's just natural that there's an overshoot and then there's a clawback. And I don't see this as a negative. I sometimes see this as a good thing. And as long as it doesn't go back to where it was, and we're still double where we were, say, a couple of months ago, right? And in Ethereum, probably more than that. So I don't see anything negative here at all.
Sure.
I think the only thing I'd add to that is, as I was alluding to it earlier, the developments on the blockchain itself, the technical developments, be it blockchain, Bitcoin blockchain, Ethereum, and other chains like, I don't know, Zilliq, Matic, Solana, and blah, blah, blah. Those are just examples. I'm not kind of giving out names saying these are the best ones, but each one of those projects is doing something innovative, and it depends on how the market reacts to that innovation to a point. And a lot of the participants are still retail, and they're succumbed to, I don't know, to pressing the button buy or sell because of how they feel rather than defined underlying causes and reasons. So I think that has to be taken with a pinch of salt.
Thanks, Konstantin. Paul, then Alessandro, then Ankush. Very quick, each of you, please.
Yeah, no, I tend to agree. I mean, look, these seem to me like natural gyrations, and it's just typical media kind of headline grabbing stuff. These are, I mean, people have been saying for years or use the excuse that markets are illiquid, but these are far more liquid markets than many other markets out there now. So I can't put it down to that, but they're very directly correlated, and Bitcoin tends to lead. And I think that US infrastructure bill was kind of just a bit of news that tempered the market somewhat. So I'm not too concerned. I prefer to look over the longer term rather than these short-term durations. We are in a bull market of some form. When that ends, who knows? It will end at some point. They always do, and it will be followed by a bear market of some form and some length. So that will come, and I just think it's a case of making sure that you trade wisely and make sure you keep enough bullets dry for future opportunities when they come in downturns.
Thanks, Paul. Alessandro, very quickly, and then Ankush.
Yeah, tend to agree. It was a short-term correction as far as it goes for now. I think rates in the market in particular were very, very high over the past few weeks. Over the past week, instead, we've seen cooling down on the farthest end of the curve. We've seen quarterly contracts coming down in price. This tells you that there is a bit of a cool down overall. Open interests before the crash were at all-time highs. So nothing new. We've seen already this flesh out of leverage. Chances are that there is nothing more. I mean, I doubt anyone knows what actually happened. There is no big news. It's just trading, I think.
Got it. How about you, Ankush? What's your view?
Yep. Yeah, quite simply an unwinding of leverage. The market was doing very well. It may or may not be driven by news. I'd say it's more to do with the supply side. Very little supply on the market, and as such, things going up very quickly due to outpaced demand. And then over the last few weeks, seen a pullback. So unwinding of leverage, the market coming back down, and at some point we will see a continuation of the bull run. So generally I'm pretty positive. I think it's natural to have these kind of corrections. We've seen them in the past. There was a buildup of leverage, and we've seen that come into play over the last few weeks.
Okay. I mean, if you read the online and print media, they'll attribute this to everything from the Chinese ban on cryptocurrencies to the SEC's rejection of a spot Bitcoin ETF or profit skimming by whales or other long-term holders. And I think each of you has collectively given us a clearer picture of what in reality is likely to be happening. I think if there's a lesson to be drawn from what's going on in the markets, it's really that the best way to approach the whole thing is carefully and in a very professional, risk-controlled manner, which is why the asset management industry exists, frankly, at the end of the day. It may well deliver those things better than people doing it on their own. Look, I want to thank all of our panelists, Paul Gordon of CoinScrum, Alessandro Balato of Fasanara Capital, Konstantin Anasimov of CXIO, and Ankush Jan of Aero Capital, who's been our host. I know that everyone watching, you will have found this terrifically informative and stimulating. And a recording of today's webinar will be circulated to attendees as well as posted. And if you want to learn any more, and this includes about CoinScrum, CXIO, and Fasanara, please get in touch with your Aero contact or via the Aero Capital website. You see the contact details on that screen there. And on that Aero Capital website, you'll in any case find an extensive library of very informative white papers and shorter thought leadership pieces. Look out in any case for news of Aero Capital's next thought leadership webinar. You will all be welcome. Thanks again to all four of you and to each of you in the audience, and also at Aero Capital, Luisa Chiavuco, for holding this all together in terms of the logistics. Goodbye for the moment.
Thanks, everyone. Bye.
Thanks very much. Goodbye.
Thank you.
Thanks.